Good morning, everybody. Thanks for joining us. This is Wealth Watch, and I'm Clint Long with WealthSouth. I'm excited about today's topic. Not that I wasn't excited about the other ones, but unlike our previous two sessions, when we talk about the investment world, it's such a broad topic range, and it really opens itself up to a lot of different questions. So we're looking forward to engagement beyond what we've already had with those of you in attendance. So as a reminder, on the right side of your screen, you should see a question and answer field. As we're going through today, please feel free to use that to get any of your questions about what we're covering answered. We would certainly appreciate some back and forth dialogue today. I'd also point out before we get going, we're going to use a lot more resource material that we're putting up on the screen. And I know some of you are maybe watching on a tablet or watching maybe on a phone. And obviously that's not going to be overly conducive to trying to read some of the data that we're going to use today. So with that in mind, we are going to house the presentation materials today in our resource center on our website. So alongside the video from today, we'll have that out there as well. So feel free, if you are watching on a phone and you want to revisit that, to go to our resource page and take a look. And if you want to know how to get there, there's a link to our resource page just under the invitation link that you would have used today to get in. So joining us today, we've got three members of our portfolio management team. We've got our senior portfolio manager, Lee Walker, our CFA charter holder and portfolio manager, Nick Smither, and our chief investment officer, James Faraday, joining us. Good morning, everybody.
Good morning. Thanks for having us, Clint.
And so again, it's going to be a little different because we're going to have multiple voices coming at you, multiple people on the screen, and so hopefully again, it's going to engage a really active dialogue. And what we want to get to is kind of the what's next, what's over the investment horizon, what do we see 2 to 3 months down the road, and maybe even beyond that. But before we can get there, there's certainly indicators that we want to use and that we want to be mindful of coming out of what's already occurred. So Lee, if you will, to get us kicked off this morning, maybe just walk us through what we've seen over the last 2 to 3 months and some of the highlights or maybe lowlights that have come out of that time.
Okay, sure thing. Thanks, Clint. Good morning, everyone. Yeah, to Clint's point, just, it's important to remember where we've been and where we are now. And so I just thought it would be helpful to share some data and some reminders around that. Given everything that's happened in the market this year from a volatility standpoint, of course, everything with COVID-19, I think it's easy to forget that we ended 2019 up almost 30% on the S&P 500. So we came into 2020 really feeling, pretty good and about how this year would shake out. And we can see that in some of the data that we've got on the first slide here. So as of January 1st of this year, the unemployment rate was 3.5%. GDP quarter over quarter, so this is a fourth quarter 2019 number, was 2.1%. The 10-year Treasury yield, 1.83%. So the Treasury was going to pay you 1.83% to borrow your money for 10 years. Seeing that number, at a higher end of the range is indicative of economic growth. And also conducive with the Fed funds rate being in that 1.5 to 1.75% range. If we cut to this week then, so as of Monday, we have an unemployment rate of 4.4%. That is a measure from March. So sadly, that does not include, a lot of this April data that we've been hearing about week over week. We will get the April number this Friday, the consensus around that number is that it could be as high as 16%. So unfortunately, we have not seen, the worst on that front yet. It's a similar case with the GDP numbers. We received the first quarter 2020 GDP number last week, and you'll see that there was a contraction of 4.8%. That at this time is a preliminary number, so we'll get that finalized number later on this month. But similar to with the unemployment rate, we don't feel that we've seen the worst of that number yet. The second quarter number, simply because that will have more of the COVID-19 effects in it, that number could be anywhere from -15 to -30%. That being said, we do think second quarter will be the worst, and then we would expect third and fourth quarter this year, while still being at a contractionary rate, to be at least a little bit better.
And Lee, to your point on the unemployment rate, I'm not sure if anyone saw, but the ADP report came out this morning, and they had lost about 20 million jobs, which is twice as many as we lost during the Great Recession. So just for context, that's where we're at this morning going into Friday's unemployment report.
Yes, thank you, Nick. That's a good point, and that leads into that consensus number of 16% that we're hearing about for Friday's number. The 10-year Treasury yield, the slide says 0.63%. We're actually at 0.72% this morning, or 72 basis points. That's a significant decrease from 1.83% at the beginning of the year. Some of that has been driven by, the monetary stimulus. We had the Fed come in twice in the month of March and reduce rates, as you can see on that next line there, to the 0 to 0.25% range. So between monetary stimulus, between just simple flight to quality, where investors are more driven to more risk-free type assets like Treasury bonds. Bonds have that inverse relationship. When rates come down, prices go up. So as those prices have gone up, with demand from investors just wanting to be in a safer investment, that's helping to drive that yield down as well.
And Lee, where a question that I get a lot from clients is where's the Fed funds rate going? It's a rate that the media puts a lot of attention on. It's a rate that really can affect a lot of businesses and personal individuals as well. Do we have a feel right now? Can you give us a feel kind of where we think that Fed funds rate's going?
Sure. Yeah, thanks, James. The expectation around that for this year, and actually for the foreseeable future, is to be in a very low rate environment. We would expect this range of 0 to 0.25% to be in place for the remainder of the year. Of course, we've seen a lot of other monetary stimulus come in too, and fiscal stimulus at that. So with all that extra, the alphabet soup, as everybody refers to the various programs that have come out, it's just that expectation will be a really low rate environment for, I've seen upwards to 2 to 3 years out. So I think we're in that for a while.
And I think as an organization, we fall in that same camp of anticipating rates to stay low for the foreseeable future, both on the short end and on the longer end of the curve. And that 10-year Treasury, just to accentuate what a huge move that was, from 183, and we got as low as, I want to say, we got down to 40 basis points, right in the middle of the market, the bear market that we experienced in March.
Right, exactly. Another element, the reason I included WTI, which is West Texas Intermediate crude oil on this slide, is that's just been another added pressure to the markets in addition to the coronavirus. So at the beginning of the year, crude oil, or the West Texas crude oil, was $61.06 a barrel. we have seen that price per barrel come down by about 2/3. This morning, that number, the price is around 23.42 was the last price I saw per barrel. So a significant decrease in oil. Some of that has been related to, the Saudi-Russia price war, but, the crux of it being just excess supply and dampened demand. Nobody's going anywhere. So while we're seeing those lower prices at the pump, unfortunately, consumers aren't necessarily able to take advantage of that like we normally would this time of year, especially anticipating summer travel, etc. But we have seen, an uptick in oil just this week. I think, up 20 to 30% just in the last couple of days, primarily on the expectation around a little bit of increased demand. That consumer confidence number, we're at the beginning of the year, we were at 126.5. If you think of this number, a baseline is 100. So anything above that number is indication that the consumer is feeling pretty good about the economy. Anything below that, not feeling as confident. So the latest reading that we have is as of April, and that number is 86.9. So no surprise there, just, lack of confidence in the economy by the consumer.
And I would just add there, Lee, before we move on to that next slide, that when you look at economic data, it typically bottoms about 3 to 6 months after markets bottom. So we don't know, hopefully we've seen the market lows in March. We think we have, but economic data is going to be very volatile over the next 3 to 6 months, and then we're going to get some really negative unemployment numbers. So we're really trying to prepare clients for that we are going to see some bad unemployment, bad earnings data come through the pipe. But keep in mind, that's usually a lag. The market is looking forward, looking ahead 6 months through to the other side of this crisis.
Right, and that would really follow suit with the fact that when we get, second quarter GDP numbers, that's going to be in July. We had the market low on March 23rd, at least so far, and hopefully that will be it. But that does follow, suit with that 3 to 4 month lag of maybe seeing some of the worst numbers this summer.
Yeah.
And to that point, just looking at this drawdown of, is this different this time around? Of course, with the data that I showed on the previous slide and the drastic change from just January 1st to this week, we can look at this chart here. I think it gives some good perspective around, previous recessions. So if you are looking at this, the red line is an indicator of a 20% market decline. The light gray bars are indications of recession periods. And then the dark gray is, what did the S&P 500 do declining from its all-time highs? So if you then look at the diamonds that are numbered, they're indicators of, what event was it that caused that recession, or in the case of number one, that was the Great Depression. So you saw, you can see in that dark gray lines, the drawdown there was, almost 90% in the Great Depression. If we cut to, some of these recessions that we're all more familiar with, the tech bubble burst, that's number 11 on the graph. So we had a drawdown there of over 40%. Number 12 is representative of the great financial crisis. So as everybody knows there, we had a drawdown of over 50%. And then number 13 showing you kind of where we are now. So I thought this was just good perspective to see that while we would never want to take away anything with the emotional, the mental, that the health perspective of this drawdown, relative to some of the past periods we've been in, it's not quite as much of a drawdown as we've seen. What's more important, I think, to consider is the timeline in which we experienced that downturn. So this slide here is overlaying essentially the great financial crisis drawdown with what we've experienced with the coronavirus. So you'll see the dark green line is representative of the post-Lehman bankruptcy, i.e. the great financial crisis, and then kind of that turquoise line, the coronavirus. So if we think of the y-axis there, the 0 being kind of that baseline of the date for post-Lehman of September 19th, 2008, we reached bear market territory, which is down 20%, and Nick will talk a little bit more about that. But that bear market being down 20%, we reached that, in just under 4 months. The coronavirus, however, that was less than a month where we were already in bear market territory. The big difference with this type of drawdown that we've experienced with the coronavirus is that this is considered an event-driven bear market. So what that means is, a single event has driven this downturn, and historically we have seen usually about an 8-month peak to trough in an event-driven bear market, and that average drawdown is about 27%. Again, we had that drawdown in less than a month. On the flip side, though, from a recovery standpoint, usual recovery period for this type of drawdown is about 13 months, and 12 months after that bottom, usually, the average return is about 30%. And that differs from the financial crisis in that was more of a structural type bear market. So there were actual structural issues around mortgages, around financial markets in general. Those types of markets usually take much longer to draw down, are much more significant, and take longer to recover. So I think that kind of speaks to, mainly the rapidity of that drawdown, speaks to some of the difference aside from this being event driven.
And I think, Lee, this is what made it so uncomfortable, just this speed of which the bear market took hold, and the speed really of which the virus took hold as well. Because if you track the new cases that were coming into America in February and March, the speed was just accelerating every day, and you could see the market was almost in direct correlation with the speed of the market. One thing I really like that chart. Clint, can you back up to the chart before real quick? Is that possible? If not, that's okay. But one of the big takeaways,
or the other one.
Yeah, that one. Is it different this time around? Yep. To me, the takeaway here that I would share with clients is you can see that recessions are a normal part of the economic cycle here. We do expect these. Did we expect the COVID virus? Absolutely not. This, like Lee said, is a purely event-driven recession. But we do anticipate, as we build out our portfolios, we anticipate recessions and we anticipate bear markets. And that's why we don't just create a portfolio. If we never were going to have a recession, we would just invest 100% equities.
Hey,
that's
James,
why we do build out balanced portfolios.
James, we've got a question. Just curious about it. Is speed? Well, let me read this and get it worded correctly. Does speed make the drop any worse? So what I assume they're driving out there is there any increased negativity out of the speed of the drop?
I think on an emotional level, yes. I think from a pure market standpoint, probably not. I think what we've seen some of this already is that usually the quicker the drawdown, the quicker the recovery on the other side. That's typically how we've seen in the past, how these type of bear markets occur. But on an emotional level, mid-March, there was so much fear and panic, and you could just feel it. Even in the office here, people were concerned about their parents, about their kids. This was more than just worried about the price of your home, like in the great financial crisis. This was I think more personal, and the speed of that certainly, I think, affected people's emotions at the time. But purely from a market standpoint, no, I don't think so. Great question, though.
Very good, thanks. Well, Lee, thanks for all the information as it relates to what we've seen. Lee mentioned that we rapidly moved into a bear market. And Nick, I know you've got some commentary about what potential recoveries can look like, but if you don't mind, just to kind of set what we're talking about here, can you briefly define maybe a bear market or a bull market, what that means, so everybody's got a context for what we're talking about?
Right. Yeah, absolutely. So as Lee mentioned, a bear market is defined as 20% drop from a market high. So you can see that on the graph there, where the red line is. That 20% market decline represents any bear market through that time period. So likewise, with bearish investors, their sentiment is generally more negative towards the market, and they're more of net sellers in periods like this. So the way they're kind of looking at the market now, or the story they're telling, is speaking on the velocity of the downturn we saw in March, is that was just unsustainable, and some stability was expected. Even with the rally that we've seen now, just the downturn we saw in March was not sustainable. And now that we're starting to see companies report earnings, so we're seeing buybacks and dividends either decrease or be suspended, cut entirely. And while we think from where we're at now, those numbers will probably increase by the end of the year, that gap between last year and this year is still going to be quite large. And kind of the golden age of capital return is coming to an end. And, companies are going to have to start managing their balance sheets more efficiently after this crisis is over. And in addition to that, the rebound we've seen in April has been surrounded by, the market or businesses reopening. And the market seems to be inappropriately conflating reopening with normalization. So just because businesses are opening their doors, that doesn't mean that the economy is going back to pre-crisis levels and that businesses are going back to pre-crisis levels. Ultimately, that decision is up to the consumer, and that's when we'll see, the rebound come from that.
And we've seen that, Nick, we've seen that in Georgia. Just, they've reopened a lot more than some other states out there, but they haven't seen the huge uptick yet. And that's going to be the balancing act, I think. Is you're exactly right, is that just because you reopen the economy doesn't mean the consumer starts going to restaurants, movies, etc. Day one coming out.
Right. It's going to be all about how comfortable they feel during the entire process, I think. And some of that's reflected in the sentiment numbers that Lee went over. And some of it's, just gut feeling as people kind of monitor what's going on and just how they feel about, getting their families out into public again. And so when you're looking at that, and on the flip side of bearish investors, we also have people on the other side of the aisle that are more bullish, looking at the current market. So they're a little bit more positive. They're looking at the rally in April and saying, the acute phase of this crisis is over, and the global economy is starting to recover. And so we've seen that in the U.S. with our weekly jobless claims. So those spiked up in March when the economy started to get shut down, and we've seen those fall every week since that initial number. And the thought is that it's going to keep decreasing as businesses do reopen going into this month and summer months as well. And in addition to that, Lee mentioned the fiscal and monetary stimulus. So we've had an enormous amount of fiscal and monetary stimulus put into place. And after we saw that market bottom in March 23rd, that's right when those stimulus packages were passed. The Fed started pumping liquidity into the markets, and they started to rebound. So that stimulus is going to kind of act as a backstop for any risk scenario. So for the market to retest those lows, it's unlikely with the amount of stimulus that's put into place now. And Washington's talking about passing some more. I thought it was 1 trillion, but I guess they're proposing 2 trillion as soon as this week. I don't think it's being met with as much urgency as the prior levels, but if that is passed, then that provides, more of a cushion for the market.
So Nick, we've got a question. Are we bulls or bears?
That's what I was getting ready to get to that. Sorry.
All right.
So where do we stand? Yeah, where do we stand in this? So we definitely think as a whole, we're better off now regarding this than we were in March. And that's reflected in the market. However, the April rise has, that was extremely enthusiastic around reopening and potential vaccines. And, the curve has flattened some, but the economic shock is still likely to last longer. Until a vaccine's created, we will likely see, a series of peaks and troughs. And it really depends on the industry, on what kind of recession recovery we've seen. So in industries like tech, we saw a huge sell-off in March and then a very quick rebound to where some companies are even positive year to date. Whereas if you look at other industries like airlines and restaurants, those are going to take a lot longer to recover, and even could, some will go out of business, some might not return to the levels that they had before. So it's going to be a little bit of a rougher recovery for those industries.
Yeah, I would concur with that. I think it's not going to be a all or nothing type scenario, right, Nick? And we've already seen this as the market has definitely started determining who are going to be the winners in this scenario, who are going to be the losers. And that's one thing I do want to share with our clients, because a normal part of a recession is that there is going to be some carnage along the way. There are going to be businesses that don't make it out of this recession, but that is normal. And that's what we're seeing as the earnings are starting to come out. We're getting a little bit of a better feel. I mean, there's certainly a lot of noise in the earnings for this past quarter, but we are getting a better feel for which companies might do better in a post-COVID type environment. So from a portfolio standpoint, we've been taking our risk postures down over the last couple of years, not knowing that COVID was coming, but as valuations have crept up, as markets have continued to climb over the last 2, 3, 5 years, we've wanted to make sure we're not overextending our clients' portfolios. So we still see some value in stocks over bonds, certainly, particularly with interest rates as low as they are, but we're certainly not putting our foot down on the pedal. The other part of our discipline in terms of the individual securities we're buying for clients is very quality orientated. So our discipline has really moved us away from some of those industries that don't have great fundamentals. So we're looking for companies with solid balance sheets, strong management, and like Nick said, a strong management is going to be needed to navigate these waters right now coming out of COVID. And cash flows. Obviously, cash is king right now. So those are the type of securities that we're looking to invest for our clients. On the flip side, we're trying to avoid those value traps. So we do think this, you look at the cruise lines, the airlines, some of the energy companies out there, valuations look great. They're trading well below many of their long-term averages, but we see those really as a value trap right now. And there's too many uncertainties for us to get real bullish on some of those sectors of the economy. So we would say, go ahead, Nick, sorry.
I was just going to add, I think the one thing we do know is that the environment coming out of this is going to be much different than it was going in. And, there's obviously going to be some growing pains in the market as businesses and consumers both adapt moving forward. And, that it's reasons like that and these sell-offs that, as James mentioned, that we, invest our clients in diversified portfolios. So we're investing in a mix of different asset classes and categories. So not only stocks, I know we spend a lot of time on the stock market, but so not just stocks, but also bonds, cash, real estate, infrastructure, real assets. And so if you're watching the news and on CNBC, you see Dow plummets 500 points, that sounds bad, but that does not generally directly affect your portfolio. So, 500 points sounds bad. It doesn't grab your attention as much as Dow drops 1.3%. But more importantly, two, we're not Dow investors, so even our U.S. equity or U.S. stock portion is going to be more, it's going to be allocated throughout different sizes of companies, small and large, and throughout different sectors and industries in order to mitigate that risk.
I think that's a great point too, is just that the media tends to highlight the most risky assets in our economy, and that tends to be a better story, right? It grabs people's attention, and that's hard for professionals, as we're managing money, is to put some of that noise to the side and lean into the discipline of portfolio management and making those prudent decisions as we go through these difficult corrections and bear markets. But this slide, I think this slide, Clint, that you've got up now, what's priced in, this goes back to 3/31, so we're already a little bit out of date. But the point here is, if you look on the right-hand side, these are the expectations for earnings of different sectors of the economy year over year. And what you'll notice here is just the huge disparity of where analysts think these earnings are going to go. Bottom of the pile, you can see energy. I think a lot of people know why, just because oil prices have gone down so much. And then on the other end of the spectrum, companies like tech, healthcare, communications sectors, which intuitively you would think would do well in this kind of environment. We're all sitting here, we're doing these live presentations, we're doing a lot of Zoom calls, a lot of Teams calls with our clients. So certainly technology seems like it's been the biggest beneficiary so far in this bear market and recession. And this is going to be a back and forth. The market is trying to figure out now, where do earnings end up for the rest of this year, and then moving into 2021. Nick or Lee, did you have any other comments on what's priced in?
I know, looking at this just in the last month, it's already a little bit outdated from at least the S&P index standpoint. So that number, looking at this year, is already down to anywhere from 125 to 135, depending on where you're looking at. And so if you look at how much earnings dropped during the financial crisis, it was about 60% or so that year. So that would put, if we dropped that much in earnings, would put us around 110 this year. So, and relatively, we were at 163 last year, just for some context there.
Yep.
Yeah. And I would just add that, I think something that's important for us as portfolio managers is we're trying to think about, are these companies going to be around this time next year, not, a quarter by quarter. And so I think, some of the rally that we saw in April is looking more at that intermediate and long-term expectation of, are these companies going to still, be doing well a year from now? And I think it's easy, especially right now, we're all living day by day and wondering day by day when the vaccine's gonna come out. And so I think with that, we end up, getting more in a short-term mindset, when for the most part, our clients and what we're trying to do for them has a little bit of a longer term time horizon. And honestly, if you don't have that longer of a time horizon, then your exposure to the stock market shouldn't really be that high at this point anyway.
Oh, great point. That's a pretty good transition. I know we're coming up closer on time here, Clint. One of the questions, just to kind of round out the discussion here from our side, and we certainly want to take more questions if those have come up. Are there any more questions, Clint? Let's take a pause.
Not right now.
Okay. So something though that I'm getting more and more calls, emails about right now is, have the markets have rebounded substantially. And have we moved too quickly? What's been the driver behind this quick rebound? So this first chart here is looking at the months from the trough. And if you focus your attention on the far right here, this is the current period we're in. So what this is saying, that 0.7 is saying this is how far we are from the bottom of the market. So assuming March, I think 23rd or 24th looks like it was the bottom of the market right now, the S&P regained at least 50% of the drawdown. So it's back up, recovered half the losses of the pullback in less than a month. That just to show you the speed. You know, we talked about the 30% decline being one of the quickest bear markets ever. Well, this has been one of the, I feel like I'm using all these ever statements in my discussions right now, but this was one of the quickest ever retracements back up. And you can look at different periods. We've got, you know, you look at the great financial crisis. It took close to a year to regain 50%. You go back to the tech crash in the early part of the decade. It took well over a year, 16 plus months. And for a lot of those companies, it took far longer than that to regain 50%. So this has just been a dramatic turnaround. So if we look at the next slide, so what's driven this quick recovery? I think one of the biggest things I'd point to is we started to get better news coming out of the healthcare world and how and around new cases of this coronavirus. So the chart on the left there, this is daily new cases, and we've all heard flattening the curve, and you know, we're all looking at different curves in our lives right now. But this was really great news that we got coming out of Italy, out of Spain, and then New York as well, where we started to see those new daily cases decrease. And the markets really rallied hard on that. There also, as we get news on either therapeutics to deal with the coronavirus, or news on new vaccines coming out, the market is taking that in and definitely rallying on those days. And that's why I think there's going to be a continued volatility in the months ahead as we get new data from a healthcare perspective. Maybe we have a second wave of this in a couple of months that certainly would affect the markets. But day in, day out, the markets are very, very focused, more so than ever, on the number of cases and how are we doing to slow that rate down. So that improved. I think that was a big part of it. To the right there, you know, a lot of people understandably are worried about unemployment. A lot of people have lost their jobs. They've been furloughed. I did think this was an interesting chart, though. If you look at, and this was through April 8th, so the data gets stale quickly, but through April 8th, most of the layoffs and the job losses have been temporary in nature. Now, certainly, I think, like I said, there's going to be businesses where that just don't come back, and they are going to be permanent job losses out there. But it is good to see that many of the layoffs that have taken place, businesses have said those are temporary, and they look to rehire those as the economy improves on the other side of this.
Hey, James, I'm sorry to cut you off, but we do have a question, and
Good.
I'm going to try to interpret this one. But the question is, are we worried about any particular ceilings? And I assume that's in reference to checkpoints. So, for example, I know I read there was concern about the S&P pushing through 2,700, pushing through 2,900. So I think that's related to this. Do we have any market ceilings that we're concerned about?
There's no particular ceiling. Do I think we've maybe moved too quickly in the short term? I think maybe we have, and I do expect. I don't necessarily think we test the lows, but I do think there's some resistance at around 2,500 on the S&P for sure. So I think there's going to be more volatility to the downside from here. If you look at our really bullish case for this year, year end is around 3,000 on the S&P, and we're after yesterday's move in the market, we're pretty close to that bull market number. So I think we're going to be in a trading range here, probably between 2,500 and 3,000 for the rest of the year. It seems like, anyway, depending on the economic data we get. Now, if we get some surprises vaccines coming online quicker, or the virus just seems to be dissipating a lot quicker than anybody thought, I think you might have some surprises to the upside. But no, there's no particular magic ceiling though that we're looking at. And I'll let Lee, Nick, do you all have any other comments around that question?
Yeah, I mean, I think it's gotten a little too high where it's at currently. It just seems the market seems to keep recycling the same news and rallying on the same news over and over again, and it can only go on for so long before we need some new catalyst to actually drive the market further than the levels where it was, I think, around 2,800 or so. I know we don't have a ceiling, but around there is probably where I would say we're a little bit overbought.
Yeah, and especially with the lack of clarity on earnings, and most of the companies that have reported have understandably said we don't want to give guidance for the rest of this year or the next couple of quarters.
Yeah, and so nobody's giving guidance, and so the market's really been relying on those companies saying, okay, we had a huge drop in March, but we've seen some stability in April, and so even though everyone's kind of going into the future blind on what potential earnings may be, they're just rallying based on the fact that there was some stability after the huge decline.
And this is not being broad-based. I mean, if you look at a lot of the returns, there's some distortion in the returns. The larger capitalization stocks, which include the Apples, the Microsofts, those FANG stocks that a lot of people talk about, the Amazons of the world, that's really driven a great percentage of this move up. So keep that in mind as well.
Right. Yeah, it's important to remember tech is now 25% of the S&P 500. So tech's held up very well throughout throughout the bear market. So when it has rallied back up, 25% of that index is in tech.
Very good. Yeah. James, did you have any other comments? Lee or Nick? We are running up against time here. So is there anything else you want to leave people with before we wrap it up?
I think just stay diversified. I mean, if you look at just the portfolio managers here today, you can see that from a hairstyle standpoint, I've gone for the post-COVID look, while Nick has gone for the shave it off look. So always important to stay
I didn't have very many options, but I'm glad we could work that into the call.
Yeah, I really wanted to. But no, I think the biggest takeaway, something we haven't talked a whole lot about, but I'd want to leave with clients is, I do think this recession looks very different from what we experienced in the great financial crisis. And a lot of us are leaning into that and saying, wow, is it the same this time? The banks are in far better shape. So they are far better capitalized. They're very well, we feel very good about the large banks in our economy, that they're going to be able to sustain a recession. And if we start to see more defaults or bankruptcies out there. So to me, that's a real big positive out there in the economy.
Very good. Well, thanks to each of you. Real quick, before I take you off the screen, I'm less concerned about your hairstyle and I'm more concerned with where all the stuff that was on your credenza got stacked and if it's about to fall over. So we'll take you off the screen now and you can start to repopulate your credenza. Thanks to our portfolio management team. I feel like that was, I know it was a lot of information, but it was really good information. And for those of you in attendance today, again, just a reminder, the data that was presented will be out there on our resource page. So feel free to go out and access that. Thanks again for joining us. I hope everybody is staying safe out there, and we look forward to seeing you next Wednesday for another topic that we cover on Wealth Watch. So until then, take care. See you next week.